and I just wanted to go over the valuation approaches we use when we value businesses. All right. So everything is risk adjusted, obviously, but these approaches allow us to figure out, okay, what's a reasonable multiple to use, and then how do we either discount that multiple or add a premium to that multiple based on the risk of the business. So you can't just use an industry multiple and say these trade at X because each company is different. Good morning, Raph here, Zatara Transaction Advisors based out of Saskatoon. And I just wanted to go over the valuation approaches we use when we value businesses. All right. So everything is risk adjusted, obviously, but these approaches allow us to figure out, okay, what's a reasonable multiple to use, and then how do we either discount that multiple or add a premium to that multiple based on the risk of the business, right? The individual risk of that individual company. So you can't just use an industry multiple and say these trade at X because each company is different. So you got your asset approaches. So this will be based off of the balance sheet, and then the income approaches. These are all forward-looking, kind of based off of they're based off the future value, the future profits of the business. And then the market approaches are all based off of obviously market multiples, and this would be looking at the past. So one looks at the future, one looks at the past. They both kind of look at multiples, though. So you've got your book value method, asset only method, orderly liquidation method, and then goodwill method. And goodwill is kind of the over the top return on the value or on the assets. There you go. So the outsized return on the assets. Book value just looks at the equity. So okay, the equity in your business is X, your business is worth X. Orderly liquidation. Okay, if we sold everything, liquidated everything at fair market value minus what it's going to cost to dispose of it, what's the value of the business? Obviously, nice thing here. This business is going up in value. This business is going up in value. It's kind of, a value check if I've been doing good, if I've been making money. Asset only, again, this looks at the total assets that you've deployed, and it neutralizes for the liabilities. So it takes out the liabilities. And then the goodwill method, again, difference between the company's fair market value and its assets. So these, this looks at the book value, right? So this is what's sitting on the balance sheet. And then this is, okay, what's the fair market value of all this? So then you have your asset approach summary, blah, blah, blah. Here are all the years. Here's all the methods. Here's what each method came out with. Your income approach. So this, again, is kind of the future-looking stuff. So the DCF kind of looks at what are the future cash flows of this business, and then let's bring them back for what's it called? Let's use a discount rate. There you go, because the present value of the cash is more valuable than the future value because of inflation, and obviously I would rather the money today than in the future, right? So there's discounts. The future cash flow is based on the weighted average cost of capital, and it allows us to figure out, okay, what's the company worth? Owner-operated method, same sort of thing. Guy's going to have to pay himself a salary. He's going to have to get a return on the capital he deploys. There's going to have to be enough for growth, and then there's going to have to be some profit / margin of safety, right? Oh, and it's got to service the debt. Right? So there you go. Financial method, same thing. It's basically just simple ROI. Here's what the expected returns are. Here's how much cash. Here's how much it's worth. Strategic method, similar thing. So it's the premium somebody's willing to pay for acquiring this as a business unit, right? So they've got a larger business, they're acquiring this to add on to their larger business. What's that worth? So you got your income approach summaries, and here are all the values. And then the market approaches are the simple multiples based on the market. So each year you got an SDE multiple, and then you kind of SDE is seller's discretionary earnings. So that'd be EBITDA plus a fair market value salary for a manager or the owner, right? So this neutralizes out what the owner, they all get neutralized out. There's recasting that goes into each of these. But this accounts for if the seller was running the business. That's the free cash we use. So it's basically EBITDA plus the owner's salary is the free cash. EBITDA is basically if you had a manager running the place, what's the free cash? And so you'll have each industry will have different multiples. We pull a bunch of comps, and then this is kind of how we calculate this EBITDA multiple. Industry rule of thumb, this is based on revenue. So certain businesses sell for X percent or X multiple of revenue. And that's the theory behind that. And then, here are all the comparables we pulled. So this one had, whatever this is, 12 direct comparables that made sense to compare this business to. And then, we weighed it all out. Obviously, you weighed out your years of revenue. You want to kind of put less weighting to outliers and more weighting to ones that are kind of within the norm, with a caveat, right? And so there you go. That's kind of how we determine generally what the price is. Obviously, all these are adjusted for risk. So there's a whole algorithm in the background that adjusts it for risk. But this would be the market value or the assumed market value of this business. Okay, God bless you. Bye.